Sean? All right, everybody. Thanks for joining us. I'm really excited to be here with Sean Martinak from Coinbase Asset Management. Sean, thanks for joining us.
Yeah, happy to be here. Thanks for inviting me. Really appreciate it.
All right, let's try that again. Sorry, I think I had issues on my end, Sean.
No worries. Can you hear me now?
I can. Sorry about that.
Great. Yeah, no
All right.
problem. Nice to be with you
Well,
today.
off to a great start. All right, so let's get into things. So I just want to start off by asking everybody if there's any questions that you have throughout the discussion. Just feel free to enter them. We're going to leave some time at the end. But what I wanted to do is I want to structure the conversation in a couple different areas, and I have some notes, kind of keep me on track. But I want to start off by talking about things like around TradFi blockchain fusion. Then I want to kind of touch on risk management because I know we've had, personally between us, we've had so many conversations around, how we view risk management in this nascent new technology. And obviously, I want to touch on some cybersecurity challenges, as much as we can talk about, regulatory landscape, and then, leave it off with a couple minutes on, top 5 trends on digital assets for 2024. But I kind of wanted to frame the conversation around this dichotomy or difference between digital ledger technology and blockchain, because I think while everyone understands when you have a discussion with them, there's this difference between the actual digital asset side of it, the cryptocurrency versus the digital ledger technology. And interestingly, if you look at some of the major GSIBs, you do see that dichotomy. You see global head of digital assets, and then you also see people working in blockchain innovation labs. But I think when we have these discussions, I think it's important to kind of frame our conversation and our responses around both the digital ledger technology side of what we're trying to do, but then also this new world of this new asset class from a digital assets perspective. So, with that frame in mind, I wanted to start with discussing like, high level, like what are your thoughts on this integration between both, again, the crypto asset side, digital ledger technology, and TradFi?
Yeah. Look, I think we see two environments emerging. We see this sort of private environment, which we typically are labeling DLT, and then we see the emergence and the sort of the maturation of a global public infrastructure, a shared infrastructure, which I think gets that blockchain label. The assets that are created on either, to me, are the same thing. These are ways of just creating property rights in the infrastructure. Both are blockchains, but the distinction for me is that we're in this infrastructure moment. We're still very early in the infrastructure moment. It's obvious if you look at the user experience interacting with these systems, whether they be in private environments or public ones, and you look at the developer experience, or you look at the set of developers that are expert in building in these tools, again, private or public, you can tell that it's not at a phase of maturity where these things are commonplace. And so I think the distinction between the two is largely drawn from a measure of how do we get going? How do we put our foot in the water, or a toe in the water? And why would, let's say, a large bank be more cautious and want a completely constrained environment versus being able to participate in that global infrastructure layer? I see it as risk management at that point. At this point, a lot of it's due to a lack of regulatory clarity, especially regulatory synchronization in different jurisdictions around the world. The challenge I have is seeing how private environments are going to keep pace with the amount of innovation and the amount of brain power that can be dedicated to a public environment in the long run. So I think ring fencing and security and limited access is extremely important. But doing that at the entire infrastructure level in a private DLT, I think is going to, in the long run, have real trouble competing with the opportunity to engage globally with a talent base that's going to be driving a public system. And I think that's largely how we look at it, is trying to figure out how to have the right level of privacy and security and institutional capabilities, but to articulate towards that public infrastructure as much as possible.
Yeah, that's a really great point, and we'll touch on it in risk management. But like that, at the tip of the spear, having this, like you said, this crowdsourced, digital ledger technology that's not owned by one entity, which is in and of itself, what we're using, right? This decentralized ledger. And then you have these traditional financial institutions, which are very risk averse and always want to stay, one, two, three, four versions behind something. So, from a TradFi experience, how do you get the traditional folks, the traditional risk people, the traditional auditors, line one risk, line two risk, how do you get them comfortable with the technology that they can't control innovation of?
Yeah. I do think in a lot of ways for those largest institutions, doing it themselves in a contained environment is how they get started and they get comfortable and probably move towards the public infrastructure in the long run, just because it will be a home to better innovation and more access. Interoperability is probably overstated, but at the same time critically important in the long run for growing this internet native financial economy. So how are they going to get there? I mean, I think that there's going to be competitive dynamics where those that move first and are able to really capture those network effects in the larger infrastructure are going to force their competition to seriously consider it. Having an isolated and ring-fenced environment could be a great way to improve margins. Might be a way to take market share from the competitors that are closest to you and most adjacent to you. But I don't think it's really going to drive the financial innovation that is possible the same way the internet has changed many other industries, which is really from the bottom up, and to unleash kind of different points of connectivity and much larger network effects in what's possible from a services perspective. So I just think you got to start somewhere, but I think everybody kind of gets forced to this coordination point of where will business be done in the long run.
You brought up an interesting point. You brought up the internet. Do you think potentially 5-10 years down the road we're going to look back and see some blockbuster Netflix type scenarios or comparisons with some of the traditional finance institutions that have not decided to really adopt this technology?
So I think of that really generally, which is when you have a major technological change, a sort of an infrastructure changeover, you kind of always have three things. You have new entrants that become incumbents through the process because they're native to the new technology. You have some major incumbents that either figure it out early or are just inherently pointed in the right direction to be able to jump the gap and transition to the new infrastructure. And then you have incumbents that don't make it, that have the wrong strategy, that just are not able to be flexible enough as an organization because they've got too much momentum in a system that is being rewritten. So I think you always have that turnover that includes some names that last, some new names, and some names that go away. But yeah, in this case, we're seeing an acceleration in how businesses can turn over, driven by internet native technology, decentralized technology. But I do think that in the capital markets and financial sphere, because there's such a challenging and necessary kind of regulatory friction wrapped around it for safety reasons, and because it's so important to sovereign strategy and domestic economies, that it'll take longer than people think, but it'll happen in a larger magnitude and at a quicker pace than the traditional system expects. So it's always kind of less than you think can happen. I don't remember the exact expression, but less than you think can happen in a year and way more than you think can happen in 10 years. I think we see that again here.
I agree. There's a topic that is, I don't want to say near and dear to me, but something that's always been on top of my mind. I'm curious to get your thoughts on this. And it's centered around real world assets and tokenization. You're
Yeah.
marrying off-chain assets, if you will, with on-chain assets. Have you given much thought from like a jurisdictional perspective? You have court systems today that are, they have jurisdiction over these real world assets, but now we have this decentralized global ledger. Like, have you thought about, or, from a compliance perspective, starting to think about, how does jurisdiction or how does litigation work, between these two different nascent worlds?
Yeah. It's not an area where I'm expert, but I think you see the early seeds of what's gonna blossom happening already. So there are, for example, we are so Project Diamond, which I'm working on with at Coinbase, we're beginning in Abu Dhabi global markets, and they've created a global digital court system. Right, so that's an example of trying to cater to the needs going forward. It's also a jurisdiction based in English law, and whether it's New York law, whether it's the standard English law, I think there are these coordination points that can be extended beyond their specific jurisdictions to be, again, a lot of it is coordination points. We're going to have cooperations between regions. There's going to be regulatory differences, but as we start to see some strong new regulatory standards emerge, I think that sets a precedent that can be adopted more easily and replicated more easily in different jurisdictions. So you kind of get this coalescence around a few standards, and it probably when it's mature and we look backwards, it'll look like a lot of other standards that have emerged, whether they be technology standards, legal standards, communication standards. There'll probably be 3 or 4 that really dominate. They'll have alliances wrapped around them where there's a lot of business being done. And then there'll be a long tail of other ways of doing things, and that'll have to integrate if you want to connect to these largest markets where everybody has that interoperability, whether it be technological or from a regulatory or legal perspective.
From a regulatory perspective, considering how certain jurisdictions are either crypto, I don't want to say adverse, but they're slow to adopt. Do you think that it's the industry's responsibility from a self-regulatory perspective to protect, its investors, or how does Coinbase Asset Management look at, from the lack of clarity from a regulatory perspective in, you taking on that responsibility for protecting your clients?
I think it behooves everybody in a new industry that has as much that can unleash as much power and as much change as this one to be open and coordinate and try to develop the most, I don't know, careful and communicable standards possible. So I think self-regulation is obviously a tremendous value add. It's not going to solve an enforcement problem in the long run, which is going to be necessary for safety and security. So I think that it helps to engage, it helps to define rules with deep knowledge of the technology itself so that there aren't mismatches. And that's where we need to lead the charge. But I think in the end, these are jurisdictions, that have their own privilege and right, and obligation to write their own rules, and they're going to have to incorporate these things at their own pace. It's going to be a process,
Yeah,
and yeah, I think we can influence it in a positive way, but we're not going to be writing the rules.
got it. All right, let's turn over to risk management, which I imagine we'll spend a decent amount of time discussing. So, broad strokes, from a risk management perspective, what are some of the new types of risks that you think have emerged for asset managers in this new space?
Well, I mean, obviously, there's a focus on the technology risk. Um, I think that there's going to be a risk associated with the breadth of assets. So the real power and potential of a lot of this technology is that you lower the cost of creation for assets, you improve efficiencies, you're going to be able to extend capital markets and financial opportunities much more widely than they have been in the old system. Those are going to introduce financial risks that are just not part of the everyday investors uh, calculus. So whether it's credit underwriting, whether it's thinking through the quality of assets that are when they're more internet native, intellectual property return streams, things like that, this is going to get multifaceted. There's going to be many more dimensions to investment analysis, so that's kind of part of the risk calculus. I come from an investment management background, so that risk calculus is going to become much more, well, it'll be higher dimensional. There'll be a lot more opportunity to create different types of businesses. On the technology side, the way I think about risk management is just it begins with a security aware design. We're getting better and better at doing that. And then there's the necessity of third party expertise. So you're going to have audit partners for software, for process, for operations surrounding this sort of internet native financial infrastructure. And then beyond that, you really need to have automated oversight built into your systems and an incident response plan. And I know those are high level categories, but I think that idea of just being aware, having great partners, and then doing your best to make risk management a computationally native or a sort of system native part of what you're building, that closed loop is going to be the right pattern. And then it's a matter of going through it and getting better and better at executing.
Now, I'm curious from like a buy versus build perspective. Do you feel that the tools that are available today for asset managers from, again, just managing risk per se, do you think that they're mature enough for the ecosystem, or do you find yourself having to go out and develop your own tools in-house to manage risk?
When you say manage risk, are you thinking about from an investment perspective, or are you thinking from a
Correct.
technology perspective?
From an
Yeah,
investment.
I think from an investment perspective, we can rely on many of the same tools we've always used. They just might be integrated in a different way. I mean, we're not going to change how risk is measured, but we might change the frequency with which risk is measured and integrate it more deeply into the systems. So I think, like anything, we're seeing the potential to automate an increasing amount of the workflow associated with business operations in general, and that applies to financial management. So I think it'll change, but it only changes in the way that we're applying new tools to the problem.
How do you account for things like ecosystem risk, or how do you account for things like staking, restaking, liquid staking? When the original asset itself might be rehypothecated, multiple times, or looking at new layer twos that are rolling up, and then you have, investors or clients that, want to, I don't want to say jump on the bandwagon in some sense, but, they're chasing yield. So how do you effectively measure from an ecosystem perspective and also just like traditional horizon scanning?
Yeah. At the moment, we're not focused on going into the long tail of assets and sort of disparate ecosystems to seek returns. I think in a lot of ways that's interesting, but it will remain small because it's the risk return can be really challenging to calculate. So I think especially for the wave of institutional capital that I think is coming into the space beginning now, that's not going to be the focus. It's not going to be that long tail of opportunities. Yeah, as far as things like rehypothecation, restaking, that seems to be a matter of just understanding the problem well, because I don't think the risk of multiple rehypothecation is foreign at all in sort of traditional financial markets. We've seen major incidents where that's caused a near unraveling of large collected leverage and major market players before. And I think that as long as the dialogue, as long as the comparisons can be made accurately, we can bring in experienced players that have dealt with that in traditional markets and have them apply their expertise to what we're seeing at probably a faster pace and obviously more network native on the crypto side. There just isn't that much new that's under the sun, right? Like we've got a few different dimensions. Things might be kind of combined together where they were kept separate before. But the idea that leverage will accrue in a system and it could lead to catastrophic losses if the risk isn't evaluated correctly and people misunderstand the pace at which they can exit a position, that sort of asset liability mismatch. These are core financial problems. We've seen these before.
I agree, but do you think the immutability of the transaction itself and the whole cryptographic custody of that key from a rehypothecation, in my mind, I think kind of brings in a little bit more risk here in the sense that you can't always get that underlying collateralized asset if, the counterparty loses that key or there's a hack. So I think there's an element of risk that is introduced from this perspective that, we haven't seen in traditional markets.
Yeah, I think that makes sense. That left tail of maybe you want to think of it as like a bearer instrument left tail when you think
Yeah.
of private keys. But then at the same time, we're disintermediating a lot of the process of ownership and action. And we've seen plenty of failures with intermediaries in the traditional system, right? You can have a trusted market participant that holds the assets of, I don't know, I think of futures markets. We've seen things like this in the past. And those can lead to catastrophic losses across an entire investor landscape. So there are trade-offs between property rights in a decentralized system and the need to rely on intermediaries. And I think that we're just exploring that trade-off space. It's not clear that one's better than the other. We're just newer to this one.
Do you think we're mature in the sense that we truly know how to evaluate intermediary risk? Again, not to bring up FTX as an example, but there's so many individuals that, in my mind, turned a blind eye to the risk that they were facing. I know from many private conversations from people that they were, steering clear from FTX just from their spidey sense, if you will. But
Yeah.
on paper, things looked great.
Yeah, I think that this is an age-old problem, and there's no maturity where the problem gets solved around fraud, around dealing with the failure of a wisdom of crowds to produce a sort of rigorous analysis. I think we go through periods of where a large portion of a market can analyze something and create momentum, and price momentum can take over and can obfuscate the left tail risks. And I think that we've seen that probably since the dawn of human civilization. So it'll probably express itself in different forms because there are new opportunities to create that infrastructure. It takes the same steady hand that it's always taken. You need people to think carefully about, which risks emerge. You need real diligence to happen at every step of the process. And yeah, and you have to be willing to make a hard call sometimes. So you're not going to participate in something because it just doesn't seem right. It's not an easy thing to do, but I don't think this is a new problem either.
Okay. Last topic on risk management before we turn on to cyber.
Yeah.
How do you think about portfolio diversification?
In general, that it's not a stable thing. And I think one of the challenges we'll see in this upcoming period is that we've had from a financial, like financial markets perspective and an asset class perspective, the last few years have shown us a lot of disruption. But, for the 10 years prior, we saw a lot of stability in the correlations between different asset types, asset classes. If you look at crypto assets right now, there tends to be a pretty low level of diversification compared to other more mature assets, and I think that's because we are in an early stage maturity. It could have tremendous potential as an investment class, but it's not diversified yet in and of itself. So yeah, I just think it's going to be tempting to take a backward looking view and look at things very statistically. And I think what's really necessary at a time like this is to take a forward looking view and to think about fundamentals as a component of diversification, not just trailing return series. That's going to be a very difficult shift for people to make because we've mechanized it in a lot of ways in the investment management landscape, portfolio construction, the risk calibration that happens as we respond to changes between asset classes. And we could see major dislocations going forward. And I think that assets denominated on these decentralized networks are going to be a big part of those dislocations. So it's just going to take a stronger reliance on theses that are updated regularly, not just statistics in the rearview mirror, I think.
Great. Actually, before we turn on, we just got a question from the audience on risk management. So I figured we'll work this in now instead of wait to the end. So the question posed from the audience is, how do you ensure the investors understand the risk that they're taking?
I mean, there are policies and procedures and ways of interacting with just the highest level of integrity. We deal with institutional investors that are professionals in the space, and even when you're entering a new asset class, you do that with caution as an institutional investor. I did this for 15 years. Yeah, there's just a tremendous amount of diligence that goes into it. So I don't think that at least from our perspective, we're engaging with a group of potential investors that are going to have a hard time wrapping their heads around it. It's just going to take time. And I think that the challenge here is that the crypto asset market grew up in a very retail forward sense. So you have a mismatch between those participating in the markets and being able to participate directly with bearer instruments, many of whom don't necessarily have that infrastructure wrapped around them, that sort of institutional requirement for diligence and documentation, and having, let's say, committees of experienced professionals that are going to help them test their ideas. So it's a little bit of it's an apples and oranges question in some ways, whether you're thinking about open markets that anyone can participate in, or whether you're thinking about the adoption by large pools of capital with seasoned investors.
Makes sense. All right, let's turn on to cyber. So you mentioned something that I think is really important: incident response. And a lot of organizations, I think, think that they're ready for an incident response. But I'd like to hear in your words, what does a true mature incident response plan look like?
Yeah, at least from my perspective, where I'm working with Project Diamond right now, we're not at that phase yet. And so I think that what's necessary is to look around at specific instances and try to draw anecdotal evidence from good quality incident response. It still feels like we're in an early phase here. Things can happen very fast in these ecosystems. So, as much as you want to say we have somebody ready 24/7, you could have atomic risks, especially when you have open, really open, permissionless bearer instruments. There's probably going to be a component of it that is inserting time lag to be able to increase the level of incident protection. I don't think we've seen that mature yet. And I think on the incident response side, it requires automation natively, right? You're not going to be able to do it from a human speed perspective alone. So that it has to be built into the systems.
Yeah, I agree in that. I think speed is of the essence when it comes to crypto from a response perspective. And I think the other thing too is involving more than just the technology folks. I see a lot of incident response plan very technology focused, and they don't involve the business per se. Involving legal, involving compliance. To understand how do we react to a certain event, I think is really important. And then also at the end of the day, who's ultimately accountable for that? Because I've seen many arguments between CISOs and general counsels and compliance officers as far as what is the direction from a particular incident and how to respond to it.
Yeah, that makes sense to me. And when I think about these incidents too, I'd be curious what you think. There's the technology risk, the sort of technical risk, but then
Mhm.
it seems to me that we're headed towards sort of a steady state where the social attacks are a bigger risk vector, where you have the ability to infiltrate processes and operations, and that's where I mean, this is what we see in a much more mature internet business model right now. Is that's where a lot of the risk the largest risk vectors come from. So I'm curious to see that evolve, but to me that seems to be a major area of focus as well, and an area where a lot of companies, I would think of Coinbase as being particularly good at this, where they have pretty mature infrastructure to think through how to handle these risks across a number of different departments.
Yeah, I agree with you. When as a risk person, looking at things, there's obviously the technology, but there's also people and there's also process. Processes can have weaknesses in it that can lead to an insider doing something that they either shouldn't be doing or they're compromised. And I think when organizations are thinking through, they tend to primarily focus on technology of, where are my keys stored, or but they don't think about what is the process in which a transaction is verified before it's signed. Looking, recently at the that individual within that organization, there was a deep fake and he was on a conference call and everybody on that conference call is fabricated and he wired $25 million out. And if you look at the process was probably video verification of the transaction to verify. And he had the entire, organization, including the CFO, which was all fabricated. So this individual followed the process. So it's getting increasingly difficult to implement, certain processes or to do security awareness training with individuals because in this case, he did what he was supposed to in this particular case. So it's definitely a challenging, for cybersecurity professionals.
Yeah, that you raise an interesting point there, and I think the idea of or the risk of including generative tools on the video side, the audio side, really could amplify this sort of the social attack risk. I don't have a better label for it, but the human attack risk vector. It'll be interesting to see how cryptographic security responds to that. How much are we proving the authenticity of a login to a webcast on a blockchain, or with some sort of cryptographic process, and how do we kind of re-anchor things away from what our senses tell us to what our computer can tell us is an authentic environment? It's going to be an interesting tension between the two.
Agreed. All right, we only have a couple minutes left, so let's touch on regulation, and we actually have a
Sure.
question that just came in. So the question is, what do you evaluate the most recent EU regulation from the asset management standpoint?
Yeah, that's honestly, that's not an area where I'm going to have a tremendous amount of expertise. I'm not particularly focused on Europe right now, and I think there's a lot of productive things going on. Obviously, Mika is making great progress, but I think that this, at least from my perspective, the regulatory landscape is changing on a global basis, and yeah, I'm not the right person to get into details on Europe.
Okay, so let's touch on the U.S. Again, broad strokes, where do you think we sit, a year or two from now from a U.S. perspective? Do you think we have
Yeah,
regulatory clarity?
I have an opinion. Again, I'm not an expert here, so it's just a personal opinion, but the US is clearly lagging behind some other jurisdictions around the world. We can probably all agree on that. What I think is interesting is there are a number of different cases that are likely to serve as forcing functions to advance particular decisions and start to lay some of that groundwork. And so I think that the legal scholars and the sort of active participants in, the analysts of what does a judge's determination really mean? How is that going to be used as precedent? Um, how does a vote on accounting standards really factor into the way that Congress might interpret or take its major next step forward after an election cycle? I think we're going to see those building blocks for longer term clarity in the U.S. be built through the court system, I would bet. Um,
Yeah,
yeah.
I certainly agree with you. I think we're going to see clarity through litigation, unfortunately. Again, my 2 cents overview is, Congress serves their constituents, and their constituents are either not knowledgeable necessarily in this particular space, so there's no overarching need or pressure from the constituents, and individual representatives and senators don't necessarily want to, take this on as, one of their, I guess, driving agenda items. So I think there's this inaction coming from Congress in some respects because they don't want to stake their reputation on something that they don't necessarily have a push from their constituents. So I think it is going to turn to the court system. So I agree with you on that front. So, just leaving with us, what are some trends for 2024 that you're excited to see this year?
Okay, I brought five because you said you wanted five.
Yep.
Okay, I'll go through them quickly.
Sure.
So I think this is a year of beginnings, especially from an institutional capital perspective. I could see them experimenting on chain, and I don't just mean buying assets. We've seen a little bit of that, but I mean actually engaging with products that are built to satisfy the institutional user that leverage on-chain interactions. So I think this is when that starts, and we'll see how far it accelerates. The next thing would be, again, sticking to kind of capital markets on chain. I think new credit instruments are going to be available. I think it's important to remind people that fixed income and credit markets are 10 times the size of equity markets globally, and we're seeing a lot of innovation there. So I think that those markets tend to have relatively high costs and frictions, large ticket sizes, and a lot of that can be alleviated with cheaper, faster, better infrastructure. And I would expect that that's going to be something that, it's already begun, but I think we'll see an acceleration there this year. I do think, in line with that, really simple, there's going to be a new category of investors associated with those instruments. So we're starting to see new digital credit funds spin up, and I think that as it expands beyond just traditional financial assets into intellectual property and other, again, we've seen experiments here, but I don't think we've really seen it get traction just yet. But 2024 could be that year into 2025. And once it gets going, you're going to see the whole industry respond, because if there's product to buy and that product is high quality, there's going to be investors to buy it. And that really starts to spin the flywheel. Getting outside of the capital markets landscape a little bit. So I think machine to machine payments are going to be really interesting. I think this could be the year where we start to see some of that happen. We were talking about it earlier with LLMs and generative models. Bots are on steroids, right? Bots can do things that they couldn't do a year ago or 2 years ago, and it's an order of magnitude difference. So you think about unleashing an automated process with all of this generative capability, and some of this infrastructure is going to allow those computer programs effectively to have their own wallet, their own financial economics wrapped around them, and to participate without the need of a company or a human to necessarily engage in each of those interactions. When I think of machine-to-machine payments, I think of that happening at just an incredible speed, and I just think it's going to be an incredibly interesting topic. And then lastly, because you asked for 5, social. I think what Farcaster is the example right now, but I think this idea of competition around the social protocol, it's time for a new wave of innovation in social media, and I could see this being unlocked in 2024.
That's great. Well, I look forward to revisiting your predictions at the end of the year. We'll have you on.
Yeah, we'll see.
We'll go through them and see how accurate you are. But I am excited about the credit markets. I think that's a really good point to point out from a size perspective, which will then obviously definitely introduce and onboard new users into the ecosystem. So, but thank you for joining us, and I really appreciate you taking the time.
Yeah, great. Thanks for having me. Appreciate it, Dave. Take care.
Thanks.